let's start out here. I'm going to go back to the map. I'm going to just close this. We're going to go to the map. I have a little map pulled up. If you wanted this exact same giant honking map, I'll show you where you can get it. Go to your chooser, go to your interactive map, and then if you click on the help file, there's actually a little link that says, show me the 150% of just the map. And it blows it up into a giant format. That's where I'm getting this graphic from. Okay. So basically, in this graphic, okay, no problem, no problem. We're on the help file of the interactive map. Okay, so this is the help file for the interactive map homepage. Yeah. There's a little link right below the top smaller graphic right there that says, blow this thing up to 150%.
It's inactive. It's just a picture.
It's just a picture. So what I do is I actually come in here and I actually come in here with markers and I say, okay, this is this. This is. I'm going to show you flow. Okay. Let's do. We can either go to Word and document what we want to do. Let's do a scenario. You guys create the scenario. Here's our tools that we're playing with accounting. Operations. I'm going to get my marker because it's a little bit easier to see. Operations is down here. Something comes in. I get it. I end up selling it out the door. And I could potentially sell out tons and tons and tons of stuff. Okay? Some sort of operations is usually down in this lower quadrant. It's tied to locations. It's tied to a bunch of different things. Okay? So why don't you give me a scenario and we're going to kind of slowly walk through what happens on these pieces. And then we're going to actually go play with it. Okay? So your accounting, if you'll notice, you have operations on the bottom and slowly things are going to rise to the top as they're needing to be happening. Okay? There's no reason to account for it until it actually happens. Okay? Or at least the system is aware that it happens.
How about we have an order for a large amount of tennis balls. We don't have them.
Okay.
We need to get some yellow tennis balls in.
Okay.
And sell them to a customer who's going on
a big tennis spree.
A big tennis ball spree. So then we need to get a PO for it, and then we have to make an invoice, get it out the door, and then account for it, I guess.
Okay, great, great. And so as soon as you said we're going to order these, are we actually getting them in, or are they still kind of out in quasi-land? Or like, what's the scenario? Once again, it comes to questions like, what's really happening? What's really happening
Well,
here?
we need to set up, I guess, another PO.
Okay, so we know that we want to eventually get some tennis balls, okay? There's no way we can jump to the middle of the map. We have to bring them in through a PO, which is tied to a vendor, okay? No problem. Are these going to actually be on order, or are we just going to get them? Because otherwise it jumps into a semi-quasi state because it's not really real yet, depending on if I'm making payments or what's going on.
I guess we have to get them.
Okay, boom. We're going to say that this is our initial flow, vendor PO inventory. Okay, no problem. What's the next step that happens?
Well, fairly straightforward. I guess we need to come up with an invoice.
Okay, so watch this. Who's our customer? We use a shopping cart to an invoice, and we say, I need to pull some out of the general inventory pool. Okay, that's standard operations that are happening. Okay, piece of cake. So at what point do we have accounting?
We got to deposit the money.
Okay, so check this out. The invoice will end up having a deposit, and it's getting connected to here. Okay, the invoice also pulls out inventory, which relates to the balance sheet. The invoice also has cost of goods and also revenue and all that kind of stuff. Pulls it here to the P&L. Okay, like there's a lot of things that are going to be happening, and all you're going to do is we're just worried about this little stream down here. But in the meantime, things are already going to be slowly cascading up to where they need to go. You're actually not going to be doing, because you're doing good operations, it's prepping for the accounting piece of that. Okay. When we got the PO, did we pay for the whole thing? Because guess what? Look what's going to filter up from the PO. Okay? Is it an accounts payable, or did we just pay the whole thing off? Did it affect the bank, which eventually affects the balance sheet? Okay?
So that kind of goes up.
Everything kind of flows up as far as like what's happening. You guys, we have spent tons of time looking at this little map and kind of being like, okay, what would I put next to each other, and how would I help develop this flow? I realize it's just little markers, but I want you to kind of see how things are going to happen. Okay?
What's REI and splits?
Perfect, perfect. That's a great question. A split is a payment on account. So instead of putting payment on account, a split, what it does is I'm going to use my plates for just a second here, for just a minute, okay? Say you owe somebody for 10 different bills. So we have this tennis ball company, and we buy tennis balls, and we buy mitts and gloves and bats and all this kind of stuff. So we've got tons and tons of POs. PO, 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 and they all have their own individual items, histories, whatever they are. They're all kind of separate, and they're individual pieces. What a split does is it goes like this. What if I actually created a big master trade to pay for all of these little guys? So I'm going to make one check, okay? I'm going to pay off this guy, this guy, this guy, but I'm going to, technically, this one master payment is going to be split and kind of subdivided into my subs. Okay, so that's what a split is. Good question. And REI is short for reimbursement. So that's what kind of would happen in that type of a level. So the reason that they're right there close to expenses is, guess what? Say Johnny, who's a user, buys something, he creates an actual expense, but he uses his own money. Okay, so technically in REI, it's part of an expense, but it also needs to be tracked over here as part of what's called the accounts payable. Okay, because we still owe Johnny. He used his own money. Okay, it's just, it kind of depends on who owes who and who's doing what. One of the other key pieces of this entire map is, look here, in the heart of it, you have users and time. You have time, time, users. Users are all over the place. They're going to be all over the place. Okay. And then foundationally, it's kind of supported by location. Okay, so some of your, how familiar are you guys with what's called chart of accounts and some of the standard little pieces of accounting? Okay, Deb, can I actually ask you, what's a chart of accounts?
It's the accounts that you have. It's your
Okay,
accounts.
so in standard accounting, you have to create this little thing called T accounts. Okay. So technically, these T accounts are in your chart of accounts. And your chart of accounts are like, okay, anytime I pay for, let's just say utilities, okay, you would create a chart of account for that. Well, if you have multiple locations, guess what you have to do? Okay, I need my T account or my chart of account for utilities -01, -02, -03. Guess what we do inside of Adilas? We don't even use chart of accounts. Okay, we basically say, create the object, assign it to the location, which automatically took that -01, -02. We don't even need that. This big old long number, we're going to let you use English. Why don't you just click on the thing that says utilities, assign it to the location, and be done. Like, we took out chart of accounts, but it literally still tracks it in a very similar way. We simulate double entry accounting, which is kind of considered a standard right now, but it's actually quite antiquated. Do you guys have any idea on the timeline for double entry accounting?
There's a credit, there's a debit.
Okay, correct. I know we're kind of getting into this, and I hope you're okay if we're kind of diverging for a minute. We will be playing tons and tons, but if you can understand what's actually happening, it'll be like, oh, I get it, okay? I am actually on a page right here. I'm just going to open up a new tab. I'm going to actually call on Shannon to read something. I'm going to go to the main Adilas.biz website, okay? And say, what makes us different? I'm going to scroll down just a little bit, and we're going to read just 2 paragraphs, okay? So basically, they might look long, but Shannon's a great reader. We're going to basically read those paragraphs right there, okay? Shannon, can you go ahead and read that?
Yep. Here's a little background on the traditional double entry accounting model that dates back to the 15th century. So 500 plus years old. Luca Pacioli, an Italian monk, wrote one of the first math textbooks called Summa de Arithmetica.
Great, that works.
That was not correctly pronunciated. In that book, he explained about how the Italian merchants kept track of their sales, which we now call double entry accounting. This guy was a genius and a math wizard for his time. Here is the kicker. This textbook came out in 1494. 2 years prior to that, Christopher Columbus in 1492 sailed the ocean blue to show people that the world was round. People were just coming out of the Dark Ages and entering into the age of the Renaissance. The only way that businesses could track their data was in giant notebooks called journals and ledgers.
Okay, stop for a second. Those are common phrases in typical accounting, okay? You have a journal and you have a ledger, okay? And they do different things, but what it is technically clear back from this model. It was different notebooks, okay? This is my work notebook. This is my real one. And they were kind of transferring some things between the things. Okay, go ahead.
They had large rooms with tons of paper copies and went through different processes of recording, adjusting, and posting their data between the different journals and ledgers. Sound familiar?
Okay, so literally, I'm going to stand up to kind of demonstrate this, but imagine if you have this book, and maybe you even had it done by month, okay? So as soon as you say it's done by month, to me it says time, okay? But imagine this. Oh, I just made a sale today. Gotta go transfer this over here. So you're literally, this is my details, and this is my, I automatically have a disconnect, okay? Because this is the way the system was set up. It was the only way they could get to this object level of the details. But they would literally transfer things. Or they would be, I'm just going to write in this notebook, oh, here comes another sale. I'm going to write in this notebook, write in this notebook. Oh my goodness, it's the end of the month. They're adding this stuff up. This is pre-calculated, pre-anything.
Abacus.
Okay, yeah, they're sliding abacus or whatever they're doing. They add it all up and they're like, sweet, looks like I sold $500 worth. They're going to take this $500 and hopefully go put it over here in the right account. Okay, this is literally how accounting was done. Details, huge gap. We move that huge sum over here. Oh, crud, I misspelled. Guess what I need to do? An adjustment. Okay, I'm going to adjust this. There's constantly small little disconnects. Okay, Shannon, thank you. I'm standing up because I'm thinking about going into acting. What do you think now? I'm just teasing you. Okay. Don't quit your day job.
Basically, they were trying to track different states and statuses of the data. Some of the processes that they used to track these changes and states of the data were called debits, negatives, and credits, positives. These debits and credits were added to things called T accounts. The different T accounts make up a bigger thing called the chart of accounts. The chart of accounts usually had a numeric value and a name associated with it. This is how they tracked things on paper and in different notebooks.
Okay, so stop for a second. So, Debbie, what's a standard account number, like say for like petty cash or something like that, just randomly?
100, I mean, very small, basic.
So it's a numeric value, okay? So she said 200, okay? So that 200, what it is it's technically an ID number. So instead of writing the word petty cash out over and over again, they would use a number. Guess what computers do automatically? They love numbers, okay? They love numbers. So we hold all this information behind the scenes, and you just point and click, and technically behind the scenes, what? Oh, that was ID number 77. And we don't even care what the ID is because it's being tracked all the way through the system, okay? Perfect. That's exactly what I was looking for.
Okay.
Sorry, Shandy, I'm going to make you find your spot again.
The chart of accounts, okay, I think we read that. These chart of accounts were then added up and used in financial documents called the income statement, profit and loss statement, or P&L, and the balance sheet. The goal was to make sure that everything got recorded and accounted for. In order to make things balanced, they had to do one entry on one side and then a matching entry on the other side of the T accounts. Thus the term double entry accounting. This standard has been followed for years and is currently the accepted way to do accounting. As a matter of fact, most computer systems that do some form of accounting have basically computerized the 500-year-old model and added their own little tweaks to the process.
Okay, so that's not trying to downplay it. There's some huge power in Peachtree and QuickBooks and some of these different things, but literally what they did is they took this whole 500-year-old model and they have basically put it into a computer system, but it still simulates that same exact process of the 500-year-old model. So here's how it works. Operation, you guys have your own little set of software, okay? When you're done, hopefully I can get a report. I'm going to put it over here and I'm going to post it in one of my other ledgers, okay? So like there's these separations between operations and accounting. It's literally the exact same thing that's going on. And what Adilas does is, just like Joe said, we're going to help you zipper this thing, okay? And so kind of help you bring it up and across and how things are going and such.